Hey guys, welcome to my channel. My name is Malik, and in today's video we're going to be going over tax write-offs for your LLC. So starting right off, tax write-off number one, we will be discussing the meals deduction. Now, meals deduction in previous years was limited to 50%. So if you calculated a total meals expense of $10,000, you'd actually be limited to a $5,000 deduction for tax purposes. As it stands now, going forward into 2021 and 2022, you actually get a 100% deduction. So that's huge for business owners that travel a lot and eat on the road a lot, for business owners that are meeting clients for dinners and lunches, or even for employers that just like to treat their employees to lunches and dinners. Now you get a 100% deduction. Going on to tax write-off number two, we will be discussing the home office deduction. A lot of you may have heard of it or may be familiar with it, but I'm assuming a lot of you don't know how it's actually calculated. Now with the home office deduction, you have two ways to calculate: the actual expense method or the simplified method. And of the two, you're going to take the larger amount or whatever amount benefits you more to lower your tax liability. So the way the actual expense method is calculated is you're taking the square footage of the office space that you're using for your business and dividing that by the total square footage of your home. So if the office space you're working in is 300 square feet and the total square footage of your home is 5,000 square feet, you would take 300 divided by 5,000, and that figure that you get is what you're going to multiply by the actual expenses. So some of the actual expenses you can include in the calculation would be things such as your phone bill, internet bill, utilities such as gas and electric, insurance that you pay on the home, and even property taxes that you pay on the home. The way the simplified method works is it's simply you take $5 per square foot, and it's limited to 300 square feet. So the max deduction you could get using the simplified method would be $1,500. So again, you would just want to calculate both methods and then take the larger of the two numbers to use as a deduction. The only stipulation with the home office deduction is that you can only use it on Schedule C of your 1040. The 1040 is your personal tax return, and Schedule C is just a schedule on the 1040 for businesses to report business income. So if for tax purposes your LLC is the entity is set up as an S Corp, a C Corp, or a partnership, you won't get to take advantage of the home office deduction. So going on to tax write-off number three, we will be going over the vehicle expense. Vehicle expense is very similar to the home office deduction in the sense that you have two different methods to calculate, and of the two, you're going to take the one that benefits you most, or the larger expense of the two. So with vehicle expense, you have the actual expense method, and then you have the standard mileage deduction. With the actual expense method, you're just taking the actual expenses for the vehicle. So it could be things such as lease payments on the vehicle, depreciation, oil changes, gas, repairs and maintenance, and things of that sort. With the standard mileage deduction, you're taking 58 cents per mile, and you're just multiplying the 58 cents, by the total miles that you drove in the course of the business. In my experience of the two methods, I noticed that clients tend to benefit a lot more from the standard mileage deduction. I mean, you figure at the 58 cent rate, if you have 3,000 miles, you would get more than half of that as a deduction. So, it really adds up when you use the standard mileage, but it all depends. Again, you want to calculate both methods and use the figure that benefits you the most. Going on to tax write-off number four, we're going to be discussing depreciation. Now, a lot of people are familiar with depreciation, but something they might not know about is an option where you get to depreciate the full amount of the asset in the year of purchase. So that option is called 179. So you could 179 expense the asset in the year of purchase and just deduct the full amount. And the way assets or depreciation usually works is you purchase an asset for your business, say a piece of equipment or machinery, and say it has a life of 7 years, you would depreciate a portion of that total cost each year for the next 7 years until you recover the full cost back. With the 179 expense option, you could depreciate the full amount of that asset in the year of purchase. The cool thing about this is you could play around with it. So depending on where you're at the end of the year, net income wise, so if you take your total sales, less all your expenses, and let's say your net income ends up being $1,000, or let's say even you're operating at a loss, it wouldn't make sense to take advantage of the 179 and deduct the full amount of the asset that year. You're already operating at a low net income, your tax liability is not going to be there, or if you're operating at a loss, you have no tax liability. So in that instance, you would want to just appreciate the asset normally over the course of the life and take a small deduction each year until you recover the cost back. Now, on the other hand, let's say you calculate your net income at the end of the year and you're showing a $50,000 net profit. In that instance, you have a high tax liability, and if you purchased any assets during that year that qualify for 179, then you would want to definitely take advantage and deduct the full amount that year to lower that tax liability. So it all just depends. If you have a good CPA or a good accountant working on your stuff, he's gonna make that decision for you and discuss it for you, or at least he should. Okay, going on to the fifth and final tax write-off we will be discussing. This is a simple one, but it doesn't come to a lot of people's minds when they're coming up with their expenses at the end of the year for their business, and that is the uniform expense. Now, I know it's a good expense and it's a good way to lower your tax liability for certain businesses, because my wife's a barber. So with her, she has to wear black clothes to work, while she's at the shop that she's at. And it's black pants, black shirts. She's always getting hair on her clothes. So the life cycle of her clothes isn't very long. Every few months she's getting rid of them and getting new clothes to wear to work. So with that being said, that's a huge deduction for her. Another good example of someone that might, have a larger uniform expense would be a YouTuber. Any outfits that you're using for your videos, you'd be able to deduct. So that's it for my video today. A little bit on my background. I am a CPA. I've worked in public accounting, doing taxes for businesses and individuals for the past 7 years. If you've seen any of my previous videos, they're majority ATM videos, and I still plan to put out ATM videos, but I'm also going to be putting out a lot of tax videos, giving tax advice and tips for business owners such as, myself. With that being said, hit the like button and subscribe to my channel, and I'll see you guys soon.